All right, it's Thursday, March 20, 2025. Income Navigator live trading and training today. So let's get rolling, and we're gonna do something a little bit different today. I thought we would do some back testing and take a look at some different strategies under some back tests. And We can certainly look at trade and trade opportunities. We can look at the account. We can cover anything that you guys want to cover. Let's take a quick look at the markets. I only want to spend about 5-10 minutes on this, and then let's get into some back testing. We'll look at some different trades, some different trade setups, uh, and get some ideas of where these trades came from, the why and the where behind some trades. So let's jump into it. Let me screen share. Let's jump into the charts quickly. This is an intraday chart of the S&P. You can see from this morning, gap down early on, pretty good hammer reversal candle, marched its way up pretty solidly. Then MACD started just to roll over here right around the 1045 mark or so, but nothing dramatic. Things look bullish on the 15-minute here for the most part. Not quite to an overbought territory on the RSI, but stochastic momentum getting a bit overbought. But as we have seen back here, it can stay overbought for hours on end. It can stay overbought from that 10:30 all the way to about 12:30, about 2 hours if need be. So it can stay there. So we'll see what happens in here overall. If we're looking at the 3-minute chart here, let's get these lined up pretty much on the dot if we can. So you can see we started losing momentum in here right around, I don't know, 10:30-ish or so, and we've been losing momentum since. We came back to the 21. This might be a good spot to launch back off, but we've just been losing a little bit of momentum on the 3, but the 15 still in good shape here. From a 0 DTE standpoint today, I think Lance got in early, like a little after 10, with a bullish trade, and he was in and out of that trade pretty quickly here, taking his profit pretty quickly on a put credit spread. Because of the fact that we had already run up a bit, we weren't quite overbought, but we weren't at levels that were overbought. I didn't know how much more juice we had to the upside with this. I think we've got a reason to stay a bit elevated on the session. I don't see a reason to head down further. I think we can still bounce, move up. Really an indecision. If you're looking at the 15 here, obviously it looks pretty good. If you're looking at the 3-minute, it looks like it got tired, and doesn't mean it can't recover a bit, but it just wanted to pull back here. So I decided to go in with an iron condor today instead of a directional trade. Anyway, something different in case you care. You may not, and it's all good. Let's take a quick look at the markets. If we're taking a look at ES in here, I posted this in the Discord so you guys can see it. But if you look at a couple things here, let's look at the fib levels from the top to the bottom of this recent move. You can see that we came up here and tagged this 38% fib, the 38.2 fib. We tagged it yesterday, failed at it. We tagged it today. We're right at it today. I think we got to get through that in order to continue anything higher. You're still right below the 200. You're right at the 21 EMA. I know maybe it's hard to see some of these things here. We're definitely not overbought. There could still be some more momentum to the upside if you're looking at the daily chart. I'm sorry, the weekly chart here. Things look a little bit more concerning on this move. And the only thing I'm cautioning of here, and again, it doesn't. I'm not saying that we're heading down or anything else is going to happen in here, except you need a change of direction will require, because you've got lower lows and potentially some lower highs. But this is not necessary. There's no higher high, higher low yet. So we'll need to come down and then move and then break, this area in here. So I'm not going to get too excited, too crazy, too carried away right at this resistance level here until we do have some sort of a higher low, and then we start to make the next higher high. But we got to have a higher low first on this to really indicate that we're all clear, ready to rock and roll to the upside. We're looking at oil. It just can, I can still, let's let a bunch of people in. If you're looking at oil, we're still in this sideways consolidation here. We haven't broken out of it. We have broken the downtrend on oil, but it's just really sideways for now. I see no reason to change any strategies on oil. I just going to trade what we see, and what we see right now is just sideways movement and some consolidation at these levels here. Maybe we'll break higher, and maybe oil will make a little bit of a run. I'm okay with what we have on, and right now we have on two strangles in oil. Both of them are up. So this is not the worst thing for us in oil here when we remain in this nice consolidation area. We could also take a quick look. Man, I don't want to get too deep into some charts. We can take a look at a little bit of volume profile as well on it. Let's take a look at oil. Okay. And we're well below the point of control here. So I think any bounce up here is going to going to be met with a little bit of resistance. There's a lot of room to the downside here. You're running into a lot of volume to the upside in here, and the point of control up around 70. So I think all of these things, create a bit of a barrier for oil. If we zoom in just a bit more, we can see a pretty good shelf in here that if we maybe bounce off of it, we could head lower. I don't think it gives you any clear insights on what's going on. If we take a look at ES really quickly on what we were doing, we are running right now into this shelf here as well, which would make me, again, it's just another reason to add a little bit of concern to what we see in here, that you've got a little bit of a shelf in here as we go out a little bit longer on the time frames. Nothing major, but I think it's interesting to every now and then take a look at volume profile on things. All right, let's keep moving. In here, I want to go quickly through these. Gold, it's kind of just meandering around. It is up slightly. It's off of its highs both days in a row. It's overdone to the upside, but still good momentum on the weekly. We could still see some higher, but you're really hitting the top of the Bollinger Band right now. You're riding it higher. You really haven't broken it severely except yesterday. You're getting close to the 3 ATR. They're both moving up and expanding. So I think this move isn't quite maybe done yet, but we'll see. I don't want to get too long in gold. I'd love to see a pullback to probably the top of this zone and then the next move higher to get really bullish on gold. Now, bonds are up today. They were up pretty substantially early on, and they've given back half of their gains on the day. They remain in a nice uptrend on the daily. Here, momentum is to the upside on the daily. I think there's still not a bad strangle opportunity on bonds, so I'm fine with where we are on it. It's starting to get away from the strangle opportunity, so I'd be cautious moving forward. I think right now bonds, you need a little bit of a pullback to give yourself another good trade. They don't set up well for 1-1-2 trades in here, so you've got to be looking at something like selling naked puts, but selling naked puts on this move as we get farther from the 21s, not the best strategy. I don't think this is the best place to sell put credit spreads. You could sell maybe, you can't really do Jade Lizards 1-1-2s because the spreads aren't narrow enough at the top for you to get enough juice on this thing. So right now, I don't have a lot of trades in the pocket that I want to try to force on bonds. They are positive. They look good. I just don't have a lot of trades at these current levels on bonds that I see. All right, so I don't want to spend too much time on these charts. Let's look at a couple quick pieces here. We talked about this the other day. Let's go to the Oh, the intraday. Let's get out of the volume profile, although we can use, let's get out of that. I just want a daily chart. So let's look at the daily chart. I just want to look at the stocks in the S&P uh, at their 200, at their 50-day moving averages, which I believe is this chart. So percent of stocks above the 50, we called the low here, which was an overextended area. We've been bouncing, so this is all pretty good for stocks. That certainly looks like a pretty decent low that was in. When you get this extended, the markets have a tendency to snap back decently from every one of these oversold levels. I think this is a chart that you definitely want to keep handy and take a look when overall the number of stocks above their 50-day moving average gets overdone to one side or another. All right, so there we go. A couple things to take a look at, and then let's look really quick one more time before we jump into some back testing on the put call ratio. So if we look at the put call ratio here, okay, it's starting to tip over. Okay, so it's broken the uptrend line, okay, which as the 10-day moving average moves higher on that trend line, the markets typically fall. As if this thing continues to move lower here, as this 10-day, as long as it continues to move lower, now it can give you a little fake out. We don't see that too often, but even down here, a little fake out, and then it continued its pattern. So I think you've just got to just understand that those can happen in here. I have to get these lined up a little bit better. Like that. Okay. But even these little fake outs here doesn't mean go and get short because the overall trend is down. Right now, the overall trend is starting to turn down. We broke the uptrend line. I think that's bullish for stocks overall. So a lot of bullish signs. I think the big thing just to keep in mind is that you want to see, a lower or a higher low, and then come back up to this line that we're at today, somewhere in this area, and break through it. I think if you can do that, things look really good for the continued short term on it. All right, let's get into some back testing. If you guys have questions, certainly let me know. But I want to take a look at a few different trades, and let me screen share. And hopefully this is something that'll interest you and that you'll get some knowledge out of it. But what I'm showing right now, if you can see, this is SPY. We're using Option Omega here. So I'm using my Option Omega testing account, and I like to see how things are going to react in different market environments. And this is where it's kind of the laboratory for me to do some testing. And if things seem to test out well, then I'll look to put them into play. I don't rely strictly on their numbers here. I have found little errors here and there, so I don't necessarily trust the numbers 100% implicitly, that I'll go hog wild on a strategy, but I like to put things in live. But what I wanted to look at today was some of the background behind the 112 trade a bit, and behind some of the other trades that I do, and how things evolve. So right now, and you can only test so many different underlyings in here. You can't test a lot of different things. But let's take a look at the original 112 is based on a 60 DTE trade, and it had two components. And those components, for the most part, were managed together, but I'm going to manage them separately for the points of this. If you would just sell a 6 delta put every single week, Monday. I can't do every other week on here, so we'll do every week. We could do once a month, but we'll just do every week. And I'm going to put a profit target of 90% and a stop loss of 200% or 2x stop. Even though the stop loss is technically 3x, here, and the max loss is 200. They use 200 as the stop, which is actually a 2x loss. I know it's a little confusing maybe if you haven't used it before. But let's take a quick look. So I'm going to use 90% profit target, which is the normal that we look at on our 112 trades at 60 days here, and a 2x loss. So based upon that, and I tested this back from January 1 of 2018 all the way through March 7th of this month. I can extend it out a little bit more, but it's pretty up to date on this. So what do we see here overall? And I'm using just I'm allocating 100% of the portfolio. Why? Just because if I keep it consistent, it gives me a sense. So if this is the only trade we were doing using all of our buying power, we're not re-entering on stops. We're just adding them on every single Monday. We add a new trade. So if we're doing 6 delta at 60 DTE, the CAGR, which is your compounded annual growth rate on these, is about 18%. So 17.9% to be specific. I'll take me off video so maybe it's easier to see everything too. I will try to monitor chat a bit. All right, let's take a quick look. So the annual rate of return is almost 18%, so it's not a bad rate of return. And the winning percentage, 83.1% win rate. Had we just put this trade on, no put debit spreads, nothing. And the put debit spread is its own trade, essentially. And it pays off when the markets are dropping a bit. However, you can trade without it, okay, and only trade the put debit spreads when the market's getting to an overbought standpoint, potentially, and just rely on this trade. It works well on its own. But let's look at the differences in the trade. So yeah, while that CAGR is half my target, it proves to me that this is a positive expectation trade. Okay? So I'll tweak it and we'll take a look at it. But from a back testing standpoint, I want to get a sense of does this trade work out over time, and where does it have some struggles in here? So it gives me a good sense of it over time. We're going to pad some of this with gains we get from the put debit spread as well. But let's just take a look at this. So this is the 6. All right, let's go and change the parameters, and let's go from 60 DTE to 120. Right, it'll take a minute for this thing to go through this, so we can wait a moment on it. But the interesting thing here is when you go from 60 to 120, it really doesn't change much about this trade. And the average days in trade was 39 and a half. Okay. So roughly 39 days when you're doing the 60-day, 39 days. When you go to the 120-day, you're going to notice that the annual rate of return is slightly less at 120 days. But one of the things that's important to realize is that we're using ES, which does change this equation quite a bit because while SPY in this background and using the percentages of the account is not as leveraged of a product, so it's not going to give you quite the same. ES is going to give you a higher return on your margin. Okay, so this is not taking into account any portfolio margin or anything else. So understanding that an 18% CAGR is pretty good when just using SPY with no portfolio margin and not using ES. All right, so with this trade at 120, now we end up with 31 trades. I'm not sure where you're seeing 3 trades. It's getting 31. So 31 trades. And here I need to double check and see why it only put on 31 trades. We did not change anything on this. Still Mondays. still weekly, still on Monday, same exact setups. So again, not sure exactly why. One trade at a time. Well, no, it's taking multiple trades at a time. It does not, it's not wait till one comes off. We do not have re-entering after exit done down here. So it should be adding more trades. Just ran this a little bit ago. But we'll take a quick look. Kager exactly the same. Winning percentage pretty much exactly the same. Days in trade takes longer. Okay, and the reason there's uh, less trades is because they haven't all come off either on these. So you've got 31 trades in here because these take a lot longer to come off. So yeah, may not have the cash. We can change some of that. I'm just giving you just some basics here. But the average days in trade here, okay, while we went from 39, what was it before last on the last one? We'll take a look. We're at 31 trades, okay, here, but it takes 76 days for these to come off. Okay. So roughly compared to the original trade at the 60, okay, which took, let's see if we can get back to it. I'm going to start it over and let's do a quick run through it here. I grabbed the wrong one. Give me a moment. Let's grab the right trade. I just need a 120-day trade. So, okay, let me just tweak this one a tad for you. We're going to do the same setup. Let's do the first one more time. You know what? Let's actually look at, we'll use 10% per trade just to see if that makes a difference. On it, we're still going to use weekly on Mondays. We're going to do 90 and 200. I'm going to redo this one again. Okay, and then we're not going to re-enter after exit on this trade. All right, so this should maybe give us a little bit of a different scoop, but we're going to just use a little bit less margin on this trade. The margin amount really doesn't matter as long as you stay consistent when you're comparing uh, between these. So we'll run this back test here. But essentially what you're getting at is that the win rate and the return between 60 and 120 days is exactly the same. The difference is going to be that with the 60-day trade, you're out of that trade a lot quicker. And the bonus for me on that is because you're out of the trade a lot quicker, you have less risk on because you have less trades on. With the 120-day trade, because they take roughly 75 days, 79 days to close, almost 80 days. Okay. So if you're at 79 days out of 120, it's about 66% of the time. They take around 70% on average to get out. All right, here we go. Let's let me add something here. Bear with me. I'm going to make one tweak of something on a trade. Okay. All right, so we'll go back to this one. A little lower Kager because we're not using 100% of the account. Let's just use this as our baseline just to give you a sense. So if we're doing the 120-day trade at 6 delta, okay, still using the 90 and 2x on here, you're going to have a Kager of 14% using no just regular margin, SPY, not ES, 14% with a win rate of 85.9. And you're out of these trades roughly in 80 days in the trade. Okay. And as I mentioned earlier, 80 days is about 70% of the time. So 80 days in trade, and this is how that trade would work out for you. The key for me here was when I moved from the 60 to the 120, I used less buying power, which means I was able to get a higher rate of return. But this still has positive expectancy. It had a pretty good little drawdown. here in 2024, was it around, that August timeframe? It got smoked in August and then back up. But still, over time, it's a positive trade. Let's look at changing this to a 60 DTE. And again, we're just trying to get a sense of which, how do you come up with a trade setup that potentially maybe works um, for you based upon what you're trying to accomplish? Again, let's give it a second to run through this. And then we'll try a couple other deltas. We can try a couple other DTEs, but this is just the naked put part. The fact that when I started these trades, I was using really 60 DTE was the key for me. And I liked the 60 because I was out of the trade quicker. It worked well. It was still running without real losses during the time frame that I was running it. And you can see even with the exception of like twice, two times, these trades hold up extremely well over time. So over time runs pretty good. All right, so here's the 60 DTE version of this. It's got about a 10% um, rate of return, 83.8% win rate. You're out of these in 41 days. So 40 of the 60 days, which again is pretty much the same as the 80 out of 120. Yeah, I'm going to run this without a stop loss. Uh, and I'm gonna run something else for you on it here. And all right, so this trade still gives you a pretty good rate of return, a little bit lower. Okay, pretty much the exact same win rate. 1% less of a win rate on these to do 6 delta at 60 DTE. Now again, you can see a major difference in these trades when I'm using only like 10% of the account or something along those lines versus 100% of the account. Still, let me not start that yet. And if you look at this thing, it's just a steady winning trade. Okay. They all lost in August of last year, and then they've recovered pretty much all of that money has recovered itself back in on it. So every time they do take a loss on these, and the one thing to draw your attention to, it's really hard to see down here, but if you look at 2022, okay, this trade was positive in 2022. Okay, we had a nice return in 2022, overall positive return in 2022, which was a bear market. So I think they run really well in a bear market. Obviously, when you have a huge vol spike or market crash, these things will struggle, but that's any trade that you have. All right, so what I'm going to do is let's take this and we're going to take off the stop because you wanted to see what a stop looked like. So let's run it without a stop right now. So this is going to be the 60, the same thing, taking profit at 90, but no stop. We'll see how this thing performs. Now, this thing's going to get slammed pretty heavily in August of last year. So it's going to get it, which is going to, I think, significantly impact your annual rate of return. But we'll take a look and see. Okay, but that's my take on it is that without a stop loss, you're going to wipe out more gains. Well, let's see. Maybe not. Okay, a couple more seconds. We'll get this thing to return. All right. Okay, well, we didn't even make it there. But without a stop loss, okay, you're essentially wiping out your entire account once and having to restart from scratch as you go through. So you were even having to build up into that August. Now that August time frame is showing any kind of a drawdown, but you basically got murdered right back here um, in 20 what is it 2000 whatever beginning of 2000 middle of 2000 here this thing took a serious hit on it. So without a stop loss, you're when COVID hits, I'm surprised we don't see a loss in August on it, but maybe we just haven't built up enough size-wise for that. Winning percentage, still great. So your winning percentage actually goes up, okay? But your average loser gets big, your max loser gets even bigger. Your max drawdown's 128%. Okay, so your max drawdown is pretty substantial, and your annual rate of return goes way, 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 way down. Okay. So again, my point to this here is as you see, removing stop losses while you think you can manage is not always the best way of running it. Let's take a look at the 60-day version. We didn't look at the 90 or the 120 without a stop, but let's look at this thing with like a 50% profit. Okay, Herb, you're asking for the same thing, but I'm going to put the stop loss back in at 200, and we're going to look at a 50% profit target on this one. So we're going to change it slightly. This is going to be, let's take it earlier and let's see what happens. Obviously, without a stop loss, this trade's not a good trade. You can't survive on a major hit. A COVID event or something like that is a total wipe of your account. So you've got to have some sort of stops in there on these naked puts. Now, this doesn't take into account rolling or anything else that you may do, right? But here we go, a little bit different. If we put a 50% stop in, here's your problem. So your CAGR on this is now down to 6%. Okay? Your win rate goes up to 89%, almost 90%, 89.7%, and you're out of these trades in 15 days, which is great. Okay, out in 15 days, awesome. Okay. We are just talking about the naked puts of the 112s. We can look at the put debit spreads in a bit, but we're just looking right now at the naked puts of the 112, which is the core of the trade. The put debit spreads are almost incidental. They do pay off in some down markets. We'll talk about those. All right. So at a 50% rate, you just can't make enough money, okay, over time, I think, to generate enough return. Now, the one way to solve that problem would be to increase your delta to, let's just say, 9 delta, and we'll leave it there. All right, so we're going to do one more here, and we're going to do a 9 delta with a 52x. I mean, we can do a million different things, and this is how you backtest, in my opinion. So you keep trying different deltas, different stops, different profit targets, different DTE. Those three variables are the keys for me to give yourself a sense of, do we have positive expectancy? Is it worth exploring? I believe it will use intraday pricing every so often because there are different times in the day where you'll get stopped. All right, so if we increase the delta up to like 9, it does improve the 50% 2x loss style trade. Okay? It works pretty well. You're still getting out early, 14 days in the trade, so 14.7 days. So you're out early. The CAGR is better, okay, 7.6%. So what you're starting to get a sense of here is that, well, if I move my delta up, I'm going to get paid more. I'm going to have faster decay with higher delta. I should have a better overall return. And again, that's just giving you a sense of how to start to construct trades. I'm not giving you the perfect trade. Even if we went up to something like 12 delta. Here, we're going to do one more here, and then we'll move on to something a little bit different. I just want you to get a sense of this is how you start to test out theories or better understand trades. Well, why would moving the delta from 6 to 9 improve this trade almost 50% better? It went from 6% to almost an 8% annual rate of return. So that's what, 33% increase by moving your delta up to 9. Well, 9 delta is going to generate more premium. It's going to have faster theta decay at the higher delta. You still get out of the trade in the same amount of time, but it's going to give you a better opportunity. So if you want trades that come off faster, you're going to have to go up to something a little bit higher delta. Now, we went all the way to a 12 delta here. It improved it a little bit more Okay, so we went to an 8.9% on a 12 delta, keeping everything the same. We're up to like a 9% from 6. So we've increased 50% better. So it's a better trade because we're at a higher delta now at the 60. When I came up with the some of the other trades, oh, and I am out of my 0 DTE Iron Condor for about a 55% winner today. So we will take that. Um, let's keep going on this. These can lead to other trades, other trade ideas. If we want to tweak this thing back to, let's just go back to the 6 delta, but we're going to go to the 120 day at 50%. Let's just see how that runs really quickly. We're back to 6 delta. We're going to stick with the 52x. So 50% profit, 2x loss. Taking profits early can be good for your trades, but you're not letting the expectancies always play out. And if your stop is too loose, one stop is going to overwhelm your number of winners if your winners are too small. So you don't want winners that are just too small. You want winners that are substantial in price. You got to find a happy medium on it. All right. So we get up to about 11%, but that's worse. So 11% here on the 120 day, the original 6% at 90 and a 2x, we were out of those trades in 80 days. Now we're out of the trade in 29 days, and we have a win rate of 91.5, which is better than it was, but our CAGR is down to 11 from 14% originally on the 120-day trade. So if you try to take profits at 50% on a 120-day trade, you're going to hurt yourself because while you're going to, get a lot more trades in potentially, uh, you're making a lot less per trade. Okay. And well, if you figure you own SPY is going to grow at about 11% a year. Yeah. Right? 10% a year on annual, 11% a year annual is just buy and hold. Right? So these are not outperforming buy and hold substantially, but this is again using SPY, okay, selling these leaps. Okay, I'm using ES, which really changes the equation quite a bit. And in a portfolio margin account, it'll change the equation even more because I'll pay 1/7 I'll use 1/7 of the buying power roughly. So I will significantly increase my rate of return. I don't recommend doing any of these using SPY in a Reg T account, which is why we use either ES or in a portfolio margin account. We could do SPY if need be, or if you want to, or SPX. But using SPY here, again, the back test gives you an idea of will this trade work? Yes. Is 11% the return I would want? Well, no, but if I'm using ES, my leverage is significantly higher. Yes, there's more risk there, but I'm testing out the potential ways to set up the trade to give me the best possible scenario of being successful. All right, let's take a quick look at what happens with a put, um, a long, if we can get the long put spreads. All right, so we're going to do these, see if we can do this thing. All right, not what I wanted to do. Let's go back. I'm going to do delta. We're going to sell roughly the 25 delta put, and then we're going to buy 50 points below that. We'll do the 100 for now. And we're going to do these at 120 days. Okay. I am not going to put in a stop on these at all. We won't stop out on a put debit spread. And Profit target. Let's put a small profit target on these. Let's just put 25% and just let's just see how this thing acts out. All right, so let's see if we can do a 25 delta 100 wide put put spread. Uh, so anyway, the goal here is, like I said a couple times now, giving yourself a chance to figure out potential trade ideas. These are campaign trade ideas. Now, can you turn this into a discretionary trade? You can, and one of the ways I do that is I may look to uh, enter based upon certain other criteria, not when entering weekly, I might look at VIX or technical analysis or something like that. Um, on these. So here's the SPY puts. This doesn't seem 100% correct on it. I'm double checking my math on these. So if you're putting, I am putting a long put on, selling the 25. Oh, I'm backwards. Give me a second. I'm buying the 25 delta. I should have recognized that early on. And I'm selling the put. I was wondering why we were making money on this thing. Let's go back and do this again. All right, so I have to sell, I'm sorry. Or we have to buy the 25 delta and sell the 100 points below that. Now we can look at QQQ as well on it. Again, you have to have a portfolio margin account. Now, NQ for futures, though, a little bit of a different animal. Not as easy to uh, not easy to get through. I'm going to wrap this up. I just want to give you some ideas today. All right, so here's what it looks like when you run these trades. Okay, well, you actually ran out of money at one point on these uh, with it, but the put debit spread is not a winning trade. We know that. The goal of those is not to win. The goal of those is that you're paying for them with some of the profits from the naked put, and in a down year, they would typically pay off for you. Now, with these, COVID smoked you pretty good, and then you just uh, are falling, continuously lower on these. So they don't really pay off well. I don't really test these out much. You know what? I gotta. I forgot we were in SPY, so I can't do 100 wide. Let's try 10 wide, which would be 100 wide on SPX. I probably could have done this on SPX instead of SPY. It would have made more sense. So let's go through. I'm still in like ES mode um, for you. It takes a while for these back tests to generate. That was a bad trade. So all right, let's go through it again, see what happens if I put one of these on. Yeah, I have tried TT back testing. I don't find it as flexible, but it's not bad. Okay. All right. So here's how this thing came out. If you were putting this on, pretty interesting that actually it performs pretty doggone well. I don't think this is right. Uh, if you're buying the 25 delta and you're selling 10 points below that on SPY, okay, it's showing a pretty good profit rate of return. This doesn't really make a whole lot of sense uh, to me on here. Uh, yeah, we can look at the trade logs on these, but it still doesn't make, I can't even see. Let's go to, well, even recent trades. You're making small debits. wins on these. It doesn't look like it's even putting on the correct trades. The legs aren't right on these. So the longs are fine, but the shorts are actually incorrect on it. I do have profit target at 25%, but it's not putting on the right trade. So this thing is still trying to figure its way out. It's putting them on like 20 wide. It's putting them on, this thing is still actually selling put debit spreads as opposed to a long put debit spread. Oh, yeah, we'll have to go back and take another look at this thing. Yeah. Yep. So we'll retest this one. I've not really tested the put debit spreads. I thought we would just throw something in here, but something is amiss on these for some reason. All right, so we'll go back and look at that. I wanted to look at something else really quickly in here with you on the put debit spread. I think it's a good thing to take a look at. If I can figure it out correctly doing these, I will. Something they're not setting them up correctly in here. They're putting it on as a short put as opposed to a long put, and we don't want that. You know what? I'm going to do one more thing. It still doesn't, still was putting on the wrong trade. We're going to do one more quick thing and then we'll move over. Anyway, I wanted to give you a sense of why a stop loss I think is key, how to actually come up with some different trade ideas. You have, to me, four variables. You have delta, you have days to expiration, you have the profit target, and then you have the stop loss. I think you move those all around to give yourself the best chance of being successful and find something that you think gives you positive expectancy over the long term. Yeah, COVID's one thing, and so testing through COVID is fine. Testing through August of last year is fine. I think that gives you a good sense of what to do. Bottom line for me was the only reason I moved from 60 to 120 days was simply a better buying power. These are still incorrect. So it's still not putting on the right trade. So it can't figure it out right now. I'll give you a couple other quick tests. I'm going to have to jump here, but there are a variety of tests here. This is how I came up with that 12 delta weekly SPY trade that I do. This is where that back test was, opened every single Monday. 30% profit target, 200, 2x loss. This is the SPY leap trade that I put on, 12 delta, 365 days. Okay, I back tested it, got beat up in August, which ours really didn't get beat up badly in August in actuality. But overall, it's still a very solid trade, averaging almost 27% a year. To me, this is still one of the best trades out there. It was hard to improve on it. You can try to get out of it quicker. If you wanted to do a 20, take profit at 20 instead of 30. I tried 50. NCAA pick cream. I I changed it a couple times. I think I have I just changed it this morning, but I actually had Duke, Florida, with Florida winning it. Um, I don't know that Duke will make it, but I liked Alabama as well. I think there's a lot of crazy games in there. Anyway, so there's my NCAA pick for you. And you can't test ES on this platform, so you have to do everything in SPY. You only have certain certain things. But knowing that ES is more highly leveraged, knowing that you can use portfolio margins. You can see here when I went to a 20% profit target, I could maybe take them off quicker, but my annual rate of return dropped substantially to 21, so that wasn't a good direction to go to for me. So again, 30 was the best. When I went to uh, 40% or 50, let's just do 50 really quick. This is the last one. This is how I came up with 30. I just kept looking at different combinations, and the win percentage is still extremely high. It's still like a 98% win rate. Right. This is all Reg T margin. Your return is greater using portfolio margin. Yeah, portfolio, it's going to be way greater because you're just using a lot less margin. So uh, while the win rate's going to be the same, essentially, your annual rate of return is going to be greater because you're going to be using a lot less buying power. You can increase the size of your trades, you can increase the returns of your trades, or you can decrease the size quantity-wise using less buying power, do other trades on it. All right. So when I went to a 50% profit target, okay, I still didn't get as good of a rate of return. It's 25, not 27, 28. The winning percentage was still good, but it wasn't enough. Okay. And look at the drawdown, in August was a lot worse. There's a lot more choppiness, a lot less smooth at 50%. And look, 96 days in the trade versus 41. So I didn't want to be in the trade that long. I wanted to be in the trade quicker. So there's some trade-offs. Maybe if this was, I might even go with something with the. It's not all about the annual rate of return. I'll give up a little bit of my rate of return to maybe tweak, or I give up a little winning percentage to maybe tweak max drawdowns or to shorten days in trade or to get more trades on. I think you've got to find what works best for you. Uh, Herb, which ones do you want me to? Which version did you want me to run with no stop? And it'll be the last thing I'll run. So just a little bit of back testing today, the one you're doing now. So if I took the stop loss off of this thing, do you want to stop out at 21 DTE or just no stops at all? 30% profit. All right, so we'll go back to the 30. So we're going to the original trade. The only thing we're doing is that instead of a 2x stop, which we have a 3x stop, I believe, on ours, but all right, so here we go. We'll see what happens. Almost there. It's like watching paint dry. I know it, but I thought this would be something interesting to go through today, just to give you some sense of how you cook trades up in a lab and how you start to come up with some trade ideas. And I recommend getting a subscription to it. So here you go. Kager goes way up, 38%. Your drawdown is pretty good. This doesn't make any sense that you didn't take any losses during COVID or what have you. So we'd have to take a look at the trade log on this one. But obviously, if you don't have a stop, uh, you may stay in the trade and uh, it may recover on you because you're out so far at 365 days. Uh, so interesting on it that was the best trade. And if I look at my my back tests really quickly here on this SPY trade, we did this trade in here, did a couple different versions of it. No, 2x stop is what we kept. It was the 6 delta 120-day trade that has a 3x stop. So even if having no stop was a little bit more beneficial to this trade, it performed really well with no stop. There. So there you go. Yeah, you gotta dive into the trade log and see if you can find any errors. It'll identify some errors in here. So, is it a perfect scenario for you? Is it perfect? Do you follow it blindly? No, I think you use it to give yourself some ideas that maybe you could implement out there. What's something that you can implement that might pay off for you down the road, and then you could potentially look uh, to live trade and tweak those, or move it to a little bit of a different platform and test it somewhere else a little bit more. All right, so there's a little bit of back testing for you. A little bit of the 60-day versus the 120-day. Results are pretty similar. What happens if you remove a stop loss? Well, on the naked put pieces, it hurts a lot. On the Because of the 60-day or the 120-day, you get hit a lot harder. If you remove it on the 365-day, because it's a longer term trade, you're a lot further away. Looks like you might have some better results. And I think you could actually go from a 2x to a 3x loss potentially. But you got to weigh the fact of, if I take a 30% profit versus 20, I mean, is 20 too small with no stop loss? And can you stomach no stop loss when you're watching massive drawdowns in your portfolio that aren't realized? They're unrealized losses, but if you watch your unrealized losses in your portfolio mount up to tens to hundreds of thousands of dollars, can you stomach it? Knowing that I'm going to stick to my plan, I think it's too much to not stop. So I think thinking that you can survive no stops sounds easier in back testing than it does in real life when in August 5th or something hits and you're watching massive drawdowns in your account, and you may be disciplined enough to sit through it, but what if it had gotten worse? August 5th, people that held did great because we recovered the next day. What if it didn't? What if it was just the start of a sell-off and we stayed elevated in volatility and we started dropping? Okay. Those people that held, they'd have been done. Uh, I lost a bit, but I've recovered most of that. Okay. Because I did stop out, even though I stopped out at some ridiculous prices on a couple things, you still stopped out and you had warning to stop out. All right. We're going to wrap it up here. I've got another meeting, and hopefully this is helpful. We'll get this posted up within the hour. See you guys. Bye bye.